Hello Propenomix people, and welcome to the supplement from the 24th of December 2023. As you know, I like to start with a quote, and this week's is, "The iron rule of nature is, you get what you reward for. If you want ants to come, you put sugar on the floor." And that's from Charlie Munger, RIP, the legendary American investor who passed late this year. So before I get stuck in, this is the final shout out for the Propenomix Advent Calendar. If you listen on a podcast platform, it's worth checking out the Propenomix YouTube for the daily posts I've done throughout December to celebrate getting to 500 subscribers on the channel. Thanks to all the regular readers and listeners who have subscribed. If you haven't yet, what are you waiting for? Please can you recommend me to a friend who you think would be interested? I'm loving the commentary, feedback and interaction that I get on here, and I'm still at the stage where I can reply to the comments. So welcome to the penultimate supplement for 2023, everyone. Yes, imagine my distress when I realised I could have referred to last week's as the anti-penultimate supplement. Still, that's sorted that one out now. One more sleep until Christmas. Don't worry, there's also one supplement left before the calendar ticks over to 2024. I'm looking at the viability of producing daily content on the YouTube channel next year. It might only be 60 seconds worth, warning in advance, but the short part of the Advent calendar has been far better received than I thought it would be. It will really encourage me to sharpen up my skills when it comes to brevity, something I definitely need to do, let's face it. So what a fortnight for the bond yields, eh? Let's start there, in case you've been living in a cavernous structure for the past fortnight. All the news, aside from the split in the Bank of England vote, has been pointing yields in one direction, down. Global and US yields, down. Federal Reserve now discussing rate cuts, down. Inflation under 4%, down. GDP contraction in Q3 2023 rather than break even, down. Recession incoming, quite a big chance now, it will be tight, although it is a complete technicality at the moment. Bond yields down. Why does this happen? For two reasons broadly. Firstly, the interest rate is deemed to be above the natural rate under which the economy would neither grow nor shrink on the back of monetary policy, so it's perfectly legitimate to expect that the next move could be a cut. Secondly, because the base rate is now well above the CPI rate of inflation, and even above core inflation for the first time in a long time, a cut becomes a legitimate tool in the Bank of England's armoury. Remember, there's really a minimum period of 6 months for rate rises to take effect, and often up to 2 years, so the entirety of the rate rise has not yet played itself out. There's likely to be more grinding to a halt in the relatively near future. In recessions, or something that looks like them, the central bank's broader brief to ensure financial stability kicks in, and they would rather be stimulating than choking off any economic growth. So, it's all good, right? Why the long face? Well, don't get me wrong, I'm celebrating the move from 4% on the 11th of December on the 5-year gilt, down to 3.3 on the 23rd of December, as much as anyone. That's nearly 0.75% that can come off 5-year mortgages. In the past month, the swap rate is actually down a little more than this, and the 3.35% 5-year swaps from the 23rd mean that rates around 5.4 with no fee could be viable in the new year, or 4.4 with a 5% fee, or somewhere in between. It's massive news while this holds up. But it's crashing, I hear you say. Why fix now? Well, remember, you can switch down rates while the application is ongoing, or hold your rate if rates go back up. This is a very rare example of a one-way bet in favour of the consumer or the individual versus the organisation. Why can you do this? Because volatility like this is very rare, and because the lenders broadly allow it at the moment. So if a lender then broke from the crowd and said that this wasn't okay, they would have a significant amount of dissatisfied customers. They may also have a regulator to deal with. Plus, this week's title will have given you a quick hat tip as to what is coming today. I haven't got the bunting out just yet. Fill your boots just now, but if you're going to get carried away like the rest of the world with the fact that inflation is over and we're going back to the old days, then I'm about to do something to your chips that isn't very Christmassy. But before I do, let's just round up the macro picture in its entirety in terms of what's changed this week. CPI was the first biggie of the week, and as mentioned, under 4%. 3.9 was the print. This was the second month in a row of a big miss to the downside. The consensus was 4.4, and the psychology of going under 4 is at least as big as the psychology of going under 5% last month. a really orderly fall in the past couple of months, although some see a trend of concern. I'm not so sure. 2 data points can't constitute a trend, and the flash PMIs discussed last week don't look recessionary right now, so that's of some comfort. Month on month, for both CPI and core, we had deflation, minus 0.2 and minus 0.3 accordingly. Black Friday perhaps plays a little part there, but so did the dying off of the spikes in energy and oil after the October the 7th incursion in the Middle East, which did not turn into the commodity melt-up that was predicted at some points. Some volatility just playing out, I think. I've chosen at points this year to calculate the 3-month to year figures as more of an up-to-date prediction. So it takes the last 3 months' figures and then compounds them 4 times to come up with an annual rate, in case that isn't clear. Core comes out at 2.01%, which would be fantastic. CPI comes out at 1.2%. Perfectly possible, and not far off my original predictions back at the beginning of 2021 to take around 4 years to get back down to target. Currently looks like I might have been a bit bearish, if you follow these arguments and agree with the mainstream. Luckily, I don't. Remember, if the facts change, I change my mind, as you would hope. Let's just stick with what the facts are, though. The little spoken of, despite making up 47% of CPI, as discussed many times this year, services inflation was a bit of an outlier. This did not crash and instead printed 6.3%, down from 6.6%. For reasons beyond my ken, there is no consensus forecast on services inflation, but with services expanding according to the flash PMIs and wage pressure increases next year, does 6.3% annualised strike you as safe territory? Or does it strike you as 2.96% contribution to the 3.9% CPI print? That's 6.3 times 47%. RPI hit 5.3. The forecast was 5.7, so continued on the way downwards, but still not crazy time territory yet. Still, this was enough for another bath on the bond yields on Wednesday. Thursday was largely uneventful. The UK borrowed slightly less than expected last month, which is better than borrowing more than expected, but Friday brought more news that sent yields down again. GDP figures revised for both Q2 and Q3 2023. Q2 revised down to 0 and Q3 revised down to minus 0.1%, a contraction. With the minus 0.3% GDP growth in October alone, it starts to look very recessionary, although this could easily be one of the most technical recessions of all time. GDP for Q4 looks like it will print either minus 0.1 or 0. If it's the former, we will have a recession. The likelihood is the economy will grow in Q1 2024, and so it would be over before it has even officially started, really. This is the textbook definition of the rhino, recession in name only. We'd rather not have one, of course, and it does impact confidence, particularly in corporates. One thing Boris did get right is that he was always invoking boosterism. He could be incredibly positive at a funeral, that one. However, if we swallow a quick rhino, it does improve the relative position of everything for 2024, which will help the Tories' tracing paper plan to keep Labour at bay in the next election. The dark days are over and here comes improvement. It won't work. It didn't work in 97, but also Starmer isn't Blair and McSweeney and Gray aren't Campbell and Mandelson either. The rest of Friday's macro metrics of note were annual GDP growth, now revised down to 0.3%. Business investment down 3.2% quarter on quarter. Ropey, but forecasts were down 4.2%. And retail sales year on year limping upwards in a tiny fashion, although again just about ahead of forecast. Retailers have basically swallowed inflation this year. Tiny growth in sales, but that's all nominal, so they are, on current figures, 3.9% worse off year on year on 0% growth. There's points over the past 12 months where they've looked much worse off than that, and my personal feeling is there's a much larger consumption wave coming next year on the back of the wage and benefits rises, as I've alluded to. So where does that leave me in my position? I'm difficult, dispassionate, and always divided. It's impossible to look at the yield movement this week and be unhappy. However, extrapolating this into multiple rate cuts and everything going smoothly next year just doesn't work for me. I'm more bullish on the economic performance, already writing off any technical recession that does occur, bearing in mind where we are now. I do think wage rises next year cause some more permanent structural unemployment in the economy. But given we still sit at 4.2% unemployment today, That isn't so bad. Productivity would actually improve, or could. However, the fact that more tax cuts are coming, Sunak has already said as much, and people at the lower end of the pay scale will have more money in their pocket in real terms, these are both inflationary factors. There's a lot more pointing to disinflation right now, but 2 sizable monthly drops don't guarantee inflation down below target in short order. In January, energy prices go up again before going down in April, based on the current forecast. Lots goes up in April, at a percentage based on last year's inflation, not today's. And in fact, this week you've seen the government intervene on what would have been a 9% increase on train tickets, which has been chipped back to a 4.9% increase because inflation has come down so quickly. One of the biggest errors is looking back at the last 15 years and using that interest rate as a benchmark. I still think that data wants to be thrown out. One of the other mistakes and traps I've definitely fallen into as well is not looking at the timing of the incidence of these rate rises. Let me explain in a bit more detail what I mean there. When rates were zero, the world was easy. Massive corporations borrow at 1.5% to 2%, investors borrow at 3%, housing associations borrow at 0.5%. Money's nearly free. Any money in the bank is solely there for rainy days and to manage cash flow. There's no investment case for holding it. When rates move up very quickly, in a space of under 2 years, but really with the majority of the yield move upwards concentrating to more like a 12 to 18 month space, with the amount of tipping off that was out there, I've referred a number of times to just how many large corporates fixed debt for an inordinately long time starting in January 2022 when they saw the rises coming. Debt servicing costs didn't go up too much. Indeed, the landlords stuck on the base rate trackers have swallowed the whole of this and been hit the hardest. Many others, especially those who read or listen to the supplement, fixed large quantities of debt for 5 years, which was the best that most of us mere mortals can do. The large companies averaged 17-year fixes in 2022, the lucky beasts. So those on base rate trackers represent about 20% of the entire market, if the relatively thin and non-transparent data on the subject that is available from corporate reports can be believed. 80% were not hit as hard with their existing stock. Then let's get on the other side of the fence. Look at the different sort of investment decisions that have had to have been made in the past few years. 2020. Should I take this loan at 2.5% with 1 year of no payments whatsoever? Genuinely no brains required here. 2021. Should I try and buy this property and get an element of return with this incredibly cheap mortgage to set against it? Early 2021. Yum yum. Later 2021. The water started to get very warm indeed, and it was hard to buy, of course. Harder decision and hard to execute even if the decision was made. 2022. Should I sell this property in this incredible market? Or break my mortgage and fix for 5 years? Should I put the rent up? Still, not much else to do with the money until late 2022. Again, not easy to execute in, but relatively easy decision making. 2023. Why should I get out of bed and put all this effort in when I can get 5 to 6% in a short-dated government gilt at no tax? Or a fixed rate account with FSCS protection for 5+ years at 5.5% at certain points? Have I got enough property anyway? A totally different set of choices and outcomes. Am I getting a better return in property in 2023 than a bank? Of course, property is for life, not just for Christmas, and I've written extensively about reinvestment risk before. So what's 2024 holding? Do I want to invest more when a Labour government brings uncertainty to the PRS? How hostile will they be? I've missed the 5.5%, but maybe 4% is still okay, especially now inflation is back down. It sure was less effort. Then throw in a sprinkle of those who still think property prices will fall next year, the dolts. You see the pretty incredible evolution. You couldn't really do that exercise over another 5-year period in the past 15 and have such stark shifts in mindset, decisions and legitimate questions to ask yourself. Sure, you can always be afraid of your own shadow. That's your prerogative. But these have, I believe, been genuine points and concerns and have meant more volatility in the supply in the PRS than we've ever seen before. But what's the kicker that's been missed here? Well, it's actually the net gain of this new interest rate landscape for those with money. Pension fund deficits? What deficits? Sorted. Cash-rich companies? Well, At the moment, we're getting 5.5% in the bank or bonds, so we don't actually need too many new projects. We're throwing off cash. We've got that long fixed debt at 2 or 3%, so actually we're okay, thanks. Cash-rich individuals, even with borrowing, as long as it's fixed at the old money rates, the same goes. The return to savers kicks in much faster than the impact of the higher rates for borrowing, which just swallows up around 125,000 mortgage holders each month who drop off. However, now they might well be dropping off 2.5% average rates to go on to 4% average rates, a lot less punitive than suggested in the middle of this year. This has some complex elements to it. Rent seeking in general, just sitting and taking interest on the money, doesn't drive productivity, innovation, long-term growth and research and development. In the past 15 years, pension funds and others have had to work very hard for the money or take fairly big risks for modest returns. Not so much as at today, and the new risk-free rate, even with 0.75% shaved off this fortnight alone, still looks very attractive, set against nearly 15 years of pain for savers of any kind. Also, the big gains here for the savers have already been seen, and now they're ebbing back, whereas the pain for those dropping off fixed rate just piles up month on month, of course. The pendulum swings back, and the data isn't clear on when and how hard that will happen. We have the advantage of being a bit slow, and the disadvantage of our core inflation still being 5.1 compared to the US's 4% core now, and the euro area's 3.6. We can't cut as quickly as the others can. We're behind the curve still. The market now believes that around May is time for the first cut. Remember, we still need that first meeting where the hawks don't vote to raise the rates again, as they just did. I can't see a lot more dropping out of the 5-year bonds just yet. We've crossed the Rubicon for the first time in a couple of years this week, and the figures 12 months ago on the yield curve are actually higher than they are today. Long may that last. It isn't necessarily permanent though. There's still inflation in this system, and I maintain there is a secular element to the post-COVID inflation landscape. Yes, there was some transitory, and yes, it has largely gone, but its spectre on wages and benefits next year remains, as I've said a few times. But it bears repeating. Remember this around April or May 2024 time, because I sure will. Okay, the Grinch is satiated. I actually wanted to end with a deeper look at the ONS figures that everyone and their dog has got obsessed with our minus 0.1% growth rate last quarter. Okay, that's 2.5 billion quid, no small beer, but in today's parlance, not a fat lot in terms of government spending. Often missed or never reported really, at the end of the ONS quarterly national accounts publications, there are 2 points. Number one, the household saving ratio is estimated at 10.1% in the latest quarter, up from 9.5% in quarter 2 2023, because of an increase in income outweighing a slight increase in expenditure. And the second point, real households' disposable income, RHDI, is estimated to have grown by 0.4%, following growth of 2.3% in quarter 2 2023. The savings ratio was down to 5.3% in 2019, so is riding still at nearly double what it was pre-pandemic, although 5.3 was historically a pretty low print. Conclusion? People are still saving more, thanks to uncertainty, volatility and inflation. And of course, rates are a bit higher than they were in 2019, so the incentive to save is higher. But in reality, most of this is driven by expectation and need rather than rate attraction. RHDI, which I consider the best metric really for households because it takes into account taxation and inflation and income, has performed in the following way quarterly since Q1 2020. I've used this as this week's image in the written version of the supplement on the Partners in Property website. So, quarter by quarter from Q1 2020, minus 1%, minus 1.9%, plus 2.6%, plus 0.4%, plus 0.2%, plus 0.4%. Then we get to see the cost of living crisis really start to kick in. Minus 0.6%, minus 0.7%, minus 0.2%, minus 1.3%, minus 0.4%. And that would take us through 2022 to the final quarter. But from there, which would have been the depths of the cost of living crisis, but from there we go plus 1.8%, minus 0.6, plus 2.3, and plus 0.4. And this is the period where wages have actually exceeded inflation. So, if you turn those percentages into an index starting from 100, you'd end up now at 101.3 at the most recent quarter we've got data for, which is Q3 2023. So let's put this another way. This is a massive improvement from the several percentage points off that has been claimed this year in several articles. The average household in real after inflation terms is now better off than they were at the end of 2019. Or, to put it one more way, our HDI, after a lot of fuss earlier this year, is now higher than it has ever been. On paper, at least, and at the average, which as discussed many times is a dangerous place to be, the cost of living crisis is absolutely over. The likely path in Q2 2024 is a monster increase. Even if inflation does hold up around 3.5%, and most forecasters have it well below that now based on recent trends, then average wage rises at 5 to 6%, say, with minimum going up 9.8, will see a massive boost to our HDI. Cut taxes, and let's face it, it will be another cut to benefit basic rate taxpayers to try and win votes. And that improves our HDI the other way. People will be feeling a lot better off because they actually will be better off in spite of all the negative chatter around inflation. So, in conclusion, before signing off for Christmas, I'm not convinced this inflation bus has driven its last journey just yet. That would mean stickier rates if I'm right, and the yields look about as low as they can get for me until confirmation of rate cuts from the central bank. It does now feel like the next MPC committee vote is 8-1. 8 hold, 1 cut. Although there's plenty of time to change that before the next meeting. I expect rates can hold up at this rate, and an independent central bank will want to be nice and slow on the way down, just as they were on the way up. A better way, in my view, would be to follow a cut, pause strategy, but that would need real confidence in forecasts, which, as noted over the past few years, have been anything but brilliant in recent years, from the Bank of England, the Office for Budgetary Responsibility, or a whole bunch of other large organisations. Lots disagree with me and are calling swap rates under 3% soon. It's worth noting that early February 2023 saw the 5-year yield at 2.83%. So it is about possible, but it's a serious departure from a base rate of 5.25. The yield curve is still deeply inverted at the front end. And although this is a long time to have been carrying an inverted yield curve, it isn't long enough to write off the inverted yield curve as a pretty good indicator of a recession. Just not yet. If we do hit a minus 0.1, minus 0.1, plus 0.2, and I'm referring to Q3 24, Q4 24, and then Q3 23, Q4 23, and Q1 24, which is perfectly possible now, we really shouldn't give it too much thought. Q2 24 could print a really healthy number if inflation does go as low as some now think, because of the boost that the extra consumption will bring to the economy. The recession the yield curve has predicted is not this technical one, if that is what's happening right now. I would take the money personally, rather than hanging around for more drops. I still believe the one-way bet referred to above is the way to go. This is not financial advice, and you should always do your own thing, of course. But I don't see a simple, nice, sweet unwinding next year to 1% inflation and 2.5% growth, I'm sorry to say. The soft landing is not even halfway through, if indeed it is happening, and I still think it's odds against to happen. So with that cheery thought, around which I'll put plenty more meat on the bones over the coming weeks and months, there's only a bit more to say. Well done for getting to the end as always. One more nudge for the Propenomix Advent Calendar. Subscribers are very, very welcome. Thanks for supporting me spreading the word. More subscribers will lead to more and better content. And for the penultimate time in 2023, keep calm and carry on.